And welcome back to WealthWise with me, your host, Jordan Kimmel. And today I'm going to bring on a friend and a colleague. It's Dylan Jovine from Behind the Markets. And there's a lot on Dylan's mind. He shares there's some things keeping him up at night. Before we get into what's keeping you up and really what you're thinking about, Dylan, let's introduce yourself to the show and the guests and let everyone know a little bit about your background, and then we'll bring it right up to date.
Hi, thanks for having me on the show. I'm grateful to be here. Always appreciate when we get a chance to talk, Jordan. Well, yeah, my background. I've been a professional investor for 30 years, owned an investment bank, Lexington Capital Partners, and in the 90s, sold it in 2000. And ever since then, I've been publishing independent research for independent investors with Behind the Markets. So we set up this independent research firm. And, basically what we're trying to do is give people that don't trust the big firms and banks on Wall Street to do what's in their best interest. We're trying to give them an independent take on things that they should really be thinking about as investors and as citizens, frankly.
Right. Well, Dylan, you said something so important to me right off the top there about independent. And what we hear right now and what I see is this kind of a herd mentality. People all kind of, all in line, either shouting that this or that, or really never going below the surface. The biggest debate I hear is value versus growth. I mean, that's pretty lightweight if you ask me. So the thing is, there's a lot of edges in the market. I have an equity edge. It's a model. What I always look for, Dylan, is people with an edge and people who aren't just with a pie chart with indexes. It's good for a lot of people. It's not good for people that watch the show and listen to us. They want people to go a little bit deeper. So if you don't mind, let's talk out the box right now. You talk about Behind the Market, that's your company. What are you thinking about that maybe people aren't giving enough weight to right now?
Well, it's a good question. Thank you for asking it. I've been thinking a lot about the fact that, we're adding $1 trillion in debt every 100 days. You know, um, it's unprecedented, and frankly, it's unsustainable. And I think, for the last year, for the very first time in our country's history, our interest payments alone cost $1 trillion, which makes it bigger than Medicare, which is frightening to me. Um, I don't, and in October, word started getting out on Wall Street, friends of mine that work in the bond area, that the government was having problems selling long bonds. So, the government, the U.S. government, is having problems selling longer bonds. Basically, what's happened is Yellen, the Treasury Secretary, has had to basically increase their short duration bonds, which forces them to pay higher rates. So basically, these bond vigilantes are pushing back on them, thankfully, and it's getting harder to sell America's bonds. People are kind of fed up with all of the debt. And, you trace this back basically to, there are a bunch of different causes, really, but it's this kind of modern monetary theory that's really been propagated on the left over the last 25 years. And now it's spread to both sides, frankly. It's not a left thing or a right thing. Everybody spends too much money. It's the one thing both parties agree on,
Right,
But
right.
the idea of modern monetary theory was basically that debt wasn't a problem. Debt was no longer a problem, so you could
Well, hold
borrow
on a
as much as
second,
you want.
Dylan. It wasn't a problem at zero interest rates, right? The payments weren't that high. And that has changed. And I think people were in this world or thinking somehow that the zero interest rate environment would sustain itself. And people
Yeah.
just literally got caught off guard.
Yeah, and anybody who knows a little bit more history than their own than the day they were born knows that we know zero interest rates, are not sustainable. It's just
Right.
crazy. And the gold market's been signaling something for the past 6 months too. The gold market's been rising. A lot of that is China really trying to chip away from the U.S. dollar, of course. But the second big problem I have is the gold market really hasn't rallied this far, this fast. I mean, it's done it 2 times in the past 50 years. One of them was in 2000 and the other one was in 1929. So basically you can see how gold is there's a problem in the system. I'm not saying the market crashes tomorrow. I don't ever predict if the market's going up or down on a macro level. What I'm saying is stocks are very expensive. Debt's getting harder to sell. Bond investors all around the world are demanding higher payments, and gold is rising. So, if it looks like a duck and quacks like a duck, it probably
Right.
is a duck.
Well, Dylan, the interesting thing is, I actually got the business in the bond side, and the bond side's a big part of the economy. People always talk about the stock market. There was a time a couple of years ago where I was actually loudly trying to scream as loud as I could. Interest rates in Europe were -2. Interest rates here were 0. And I was saying, why don't we take all of our debt, roll it out, and issue some 1% 100-year bonds? And had we done that at that time, the
Oh
mess we
gosh,
wouldn't be
yeah,
here right now. But
yeah.
so I'm gonna walk ahead of I don't walk on water, but let me just bring this thing up. We talk about the government debt, everybody knows it. There's a really interesting fact that I saw came out early this week that US equity for individuals, the equity wealth for individuals, top Dylan, I just couldn't believe this number. It's $160 trillion of wealth in American citizens, and the government's 35 trillion in debt. We don't really, understand how that all works. But the thing is that a lot of the public, most of the public is living paycheck to paycheck, and they're not even really invested. It's the top 10% and then the top 1% that own, all this immense wealth. But the fact is that what people are willing to do is whistle past the graveyard, saying the debt's not a problem, equity should go higher, and a lot of these people just simply don't understand risk too well. And so before we take a break, because I want to take a break and go into some other things. What else other than the debt? Because everyone's talking about the debt, Dylan. What is something going on behind the markets that you're also thinking
Well,
about that
yeah.
you don't think it gets enough play?
So, two things I want to mention. First of all, a friend of mine, Rich Smith, just wrote a book called Understanding National Wealth. He basically, and every year he updates it, it's basically a balance sheet for America, to speak to
Okay.
your assets versus liabilities.
Right, right.
So, basically, so he'll tell you that the United States is worth, $200 trillion, in terms of that. But we have debt. When you talk about 35 trillion in bonds, we also have underfunded liabilities that really spike that number up. So to get a more accurate view of that, I'd go and read Rich Smith's book. Really will break down the actual economic health of this country. The other thing that's concerning me is, obviously, China. We are clearly in a geopolitical competition with China. It's a technology Cold War at the very least. And, I Xi Jinping is, he's made it clear that he wants to take Taiwan. So I don't think that he believes he's a man of destiny. I mean, this is a man who actually thinks he's a man of destiny. So, if you look at this, if you read Foreign Affairs, if you read The Diplomat, all these sources, they all agree that China is in the pre-war military tempo right now for an invasion of Taiwan. Right. So the Biden administration did what the Trump administration did, which was they basically clamped down on semiconductors, on exports to China. Now, if you're China, you're actually looking 90 miles, 96 miles across your coast and saying, all the semiconductors we need are right there,
Right.
for AI and for all this stuff. So they're going to have to make a choice, a decision, whether the gap that they're going to see between us and America as AI in this country really takes off, if they want that gap to keep getting wider between us, or they want to make a move on Taiwan to really lock down all the semiconductor capacity that they have over there. And, again, as I was saying, Xi Jinping thinks he's a man of destiny. He believes that his mission on Earth is to reunify China, Taiwan, even though China has never ruled Taiwan. This government's never ruled it. So, that would be a disaster for us. I mean, it would make
Oh
the
my
financial
goodness.
crisis, it would make the financial crisis look like a rounding error,
Oh my
you know?
goodness. When you talk about, that, and again, we know what's around the corner, and we know it's happening. They're talking enough about it. What I like to look at for the moment is I let the market do the talking, and you look at Taiwan semi and you look at the stock charts, it doesn't look like they're getting invaded, right now. I always like to look at the underlying to see how they're doing. Taiwan Semi's not acting like it's scared, but what you're saying is an eventuality. What you're saying about the debt coming to roost is an eventuality. And those are scary things. And what I find it hard is for people to actually be able to think long term, 20, 30 years, put yourself in a mutual fund and don't watch it with these kind of things, keeping you up at night. It's not easy.
Well, remember something, so in the short term, obviously Taiwan's doing great. Taiwan Semiconductor is doing great. But you think about a guy like Buffett, and I'm a long-term investor. Basically my ideal holding time is forever, of course. But basically I'm looking at longer term, 1 to 3 year windows. You look at a guy like Buffett who bought Taiwan Semiconductor and literally sold it, 6 months later because of these geopolitical risks earlier this year. So, there's a lot of signals from longer term investors that are saying this is not a safe place. But of course, in the short term, yeah, it's a bull market for Taiwan Semiconductor.
Right. Well, it's a bull market for everything touching AI or thinking of AI.
Sure.
You have to realize it's real. You also have to realize people are paying anything. And when you pay anything for something, it's a problem. Here's what I want to
Yeah.
do. Here's what Dylan, I want to take a real quick break. I want to come back, more themes that you're thinking
Okay.
about,
Yeah.
and maybe how our investors should deal with it. So we'll take a real quick break from WealthWise. It's Jordan Kimmel with Dylan Jovine from Behind the Markets. We'll be right back.
Ready to up your game and learn more about the thrilling world of sports betting? Introducing Double Down with Breslow, the ultimate podcast about the business of sports gambling. Join me, James Breslow, and a long list of expert guests as we dive into the art and science of the sports betting industry. Evolving regulations, technology enhancements, and the meteoric rise in the number of players makes this sector the fastest growing and most intriguing in the world. Unlock the business secrets from many of the industry's most recognizable C-suite executives, including famous odds makers and influencers. Every episode of Double Down with Breslow is packed with insider tips, deeply skilled analysis, and in-depth discussions. Don't miss out on the ultimate resource for mastering the business of sports betting. Listen to Double Down with Breslow on the Evergreen Podcast Network or wherever you listen to podcasts. That's Double Down with Breslow, the business of sports betting podcast.
And welcome back to WealthWise with me, your host, Jordan Kimmel. We're with Dylan Jovine from Behind the Markets. 30 years of experience, Dylan, should not be ignored. What we're hearing and seeing right now is you've got a wave coming. It's another technology wave. It's AI. If you haven't heard about it, you're under a rock for 2 full years right now. But what's happening is, as a value guy, you want to make sure what you're paying. What people are saying is, throw all the metrics out, man. This time it's different. I'm never sure that this time it's different.
Yeah.
But
When have you heard that before?
I know you're doing some deeper research in AI than I'm doing. I like individual company research. Tell us what your research is telling us about AI, what's coming, what people might even not know about yet.
Well, okay. Good question. Thank you for asking it. Basically, remember the internet. Basically in the 90s, the internet exploded. You had the first surge, right? And then there was this big kind of crash, this overinflated money, too much money chasing too few opportunities. And then it kind of died for a few years. And the second surge in the 2000s, 2010s was like 10, 20 times bigger. Right. So I think that we're getting the first wave of AI we're getting on the tail end of the first wave of AI. The big money's been made in the NVIDIAs of the world and Supermicros and Palantir and all these other things that these other stocks that we've owned. And that's been great, but we're unwinding our first wave AI bets, a lot of them. So basically the question we're asking ourselves, or we started asking ourselves a couple months ago, is what does the second wave look like? Because again, we know in the first wave of any new thing that too much money chases it. It's like Buffett's example about the airline industry. In 1960, there were 10 million seats sold in the airline industry. By 1970, there were 100 million seats sold. But during that time, the industry lost $3 billion, $2.8 billion. So basically, you can have 10x growth and lose, $3 billion because all the money chases, and there's only a few really good opportunities, right?
Right.
So we're starting to see these second tier, third tier opportunities going after. So I think the first wave is over. The question we've been asking ourselves is, what does that second wave really look like? I was reading an article, and the CTO of Dell said, quantum computing is going to be the second wave of AI. It's really going to push AI on steroids, because you're going to actually be able to calculate things at a speed that it's hard to understand, frankly,
Right.
with quantum positioning, So basically, and, in this article, this tech article that he was talking about, he said in his mind, the CTO of Dell predicts this convergence is happening right now as we speak in 2024. Quote, this convergence will happen in 2024, end quote. So, so basically behind the scenes, what you're seeing now are these AI firms starting to play with that kind of processing power, quantum processing power. And, there were a bunch of firms that were really starting to dig into there to really talk about what is the next wave? What does the next NVIDIA look like? What are these next big breakthroughs? And, we're starting to really do deep dive research on that to try to understand, to try to value what we think they're going to be versus the price they're selling at today to go for the leaders in that. So, I think we're coming to a wave of this first wave. I think we're coming to the end of that. The question is, what does the second wave look like? And I think quantum is going to be a big part of it.
Right. And Dylan, where my mind goes is what the actual solutions that these large language or the machine learning, quantum, you give it a task and say, we have an underfed population, and we have, and just let the machine go with ideas, with machine learning and more and more iterations, and it's going to solve some problems. I have a kid who's now 28. When he was 10-ish, he said to me, Dad, this is not an energy problem. This could be an energy solution, and that's really the key. We're hung up on what the problems are. I do believe that AI is going to solve some things. The question is, what to invest in. And again, NVIDIA is on top of everyone's tongue list. It's in our index. We can't help it. It ranks up high on Magnet, but the valuation, the price to sale seems stretched.
The money's been made. Yeah, the money's been made in NVIDIA already. The big money,
Right. And so the thing is, what are the next companies? And then, so let me just, if I can, I want to mention, I know that one of the things you research is biotech, and think about the speed of innovation that's going to come in that world. And so what I want to ask you specifically, in my world, it's revenue, it's cash flow, it's margin growth, it's a few factors that go into Magnet that are all fundamental. Biotech or early stage biotech does not have that. There's no revenue yet, there's no earnings yet, there's no profitability. I want to ask you, just in a nutshell, in that one sector, what is it that maybe you do that gives you an edge looking there? And then maybe when you come across companies, what is it that makes you turn away? And through your experience, you say, I want a piece of that.
That's a good question. So, I'm not a scientist or a doctor, but I've developed a system by getting my butt kicked many, many times over many, many years. And I call it blunt force logic,
Okay.
But basically what I'm looking for with biotech is I'm looking for a small biotech, that's really using new technology to solve a big old problem. So basically Pfizer, let's say, has a lymphoma franchise. They're selling a drug, $2 billion a year in their franchise, for example, and it's an old chemical drug. Chemotherapy, chemical therapy. These are drugs that are invented 50, 60 years ago, a lot of them, still the ones popularly prescribed today. So basically you want to, it's crazy, really. Right. Did you say weed killer?
Yeah.
Yeah, basically. Right, exactly. So yeah, that's funny. So basically you have, these companies, these big pharma companies are, they're selling these 50, 60-year-old chemical drugs, making $2-3 billion a year. So what I'm looking for is a small, tiny biotech that's using really, DNA targeting to really either attack the DNA of the cancer itself or to work with the body's immune system to inhibit one of our cells. So basically, we want small biotechs focusing on big problems that big pharma is already making billions of dollars a year. Now, we don't want to touch phase one because it's, two guys in a lab testing mice. But when, our specialty is late phase two, early phase three, because basically by phase two, you're testing different dosing regimens, in addition to safety, et cetera, different subpopulations, and you're expanding that out in volume in phase three. So we want to know in late phase two, when these companies start reporting early results, that they're not making people sick, or the side effects are reasonable, the efficacy is there. We start to really look at these and say to ourselves, okay, if this drug gets across the finish line, from phase three onwards, what does that mean for Pfizer or Merck or Glaxo or whomever else is serving that market? So we like to put ourselves in a position to buy these small biotechs where big pharma says, my goodness, if we don't buy this tiny little company, our competitor is going to buy this company and muscle in on our territory and take our $2 billion a year lymphoma franchise. So basically, these biotechs have a new technology that is so exceptional, that solves the problem so well with such higher efficacy and proof, that big pharma really has no choice but to defend its territory and buy them out, lest it cede its position to a competitor.
Right. No, it's exactly the way it works, Dylan. That's experience talking, and not at all. Listen, what happens when you're in your position and my position every day, we have tips coming to us, people giving us information, people giving us some thoughts. What's really important is to have a rigorous process to get through all those, and to make sure that the only things that end up in your portfolio have been vetted and understood. And this concept of trading on moving averages, and just, these bots that are running wild. And Dylan, I want to give you, one thing just to today. About a month ago, I thought that Apple computer, Big Apple, looked dead in the water. It really did. And the chart looked bad. The fundamentals don't give it a high ranking. In the last month, Apple's put on about $800 billion of market cap. Okay, so Oracle just hit a new high today. That's two Oracles combined, the world's largest database company. It just put on 800 billion dollars of market cap. What this says to me is the energy within the market, the capital in the market that's looking for ideas. Once it gets triggered, there's really no telling.
A lot of money. Yeah, it's a lot of money. It also shows you that there's not a lot of great original ideas out there. You know what I mean? Basically, these things are just being priced to perfection immediately. Apple adopts ChatGPT's AI and the stock hits a new high. Really? So, I mean, that's not even original. Apple's not even doing original breakthrough there. It's not like they announced their new AI system. This is like a retread idea chased by retread Wall Street firms that are just a FOMO, fear of missing out on these tech rallies.
Right.
It's crazy to me. It just shows how little good ideas there are out there to chase a shit. Apple's big earnings. They're using ChatGPT. Okay, big deal. Like, and I'm using ChatGPT too.
This is the point, Dylan. This is why we want to bring you on periodically. And folks, I want you to know that Dylan Behind the Markets also going to become a contributor to our newsletter. What we need here is people that think independently. We don't really need a consensus and trade in the most crowded trades in the world to try to make money. And yes, it's true right now. There's a few super crowded trades that are working, but we're going to try to bring you some individual thoughts and things maybe that
if not everyone's
talking about. Go, Dylan, hit it.
In that, just leave your viewers off with this. One of the things I didn't talk about is AI. I got so caught up on the debt argument that AI is pushing obviously up utilities and energy sector stocks. So to give your viewers some symbols that they might want to keep an eye on, like American Electric Power, AEP, NEE, PCG, SRE, there's still room to run in those utility stocks. They're paying good yields, and there's still room to run. The other thing that's very interesting is Bitcoin miners now. When you look at Bitcoin miners here, these crypto, crypto was all the rage, but now these AI firms are actually, so Bitcoin miners, you need fast processors, fast servers, and energy contracts. Lots of energy, long-term energy contracts. Right. Who else needs that? AI firms. So what you're seeing now is these AI firms that have this need for infrastructure and long-term energy contracts at a reasonable price are starting to acquire these Bitcoin miners. You're going to see a lot of action in that department in the coming months.
Interesting. I know a couple of the symbols, the value looks high, but the question is if there's a utility and there's something unique about them, Dylan. What we've seen is there's no price too high for good ideas these days. And
For
I
better
just
and
want
for
to make
worse.
sure that I'm in the first or second wave. I don't want to be the last guy having the last
Right,
trick or
right,
punch
right.
at the party. So,
Yeah,
hey,
yeah.
Dylan, it's a great segment today. Welcome to the show. You're going to be a
Thank you for
regular.
having me.
And if you have any special ideas anytime, let us know. We'll bring you right on.
Okay. You got it.
So here we are. Let's wrap up. It's WealthWise with Jordan Kimmel. Dylan Jovine, thanks so much. You nailed it. And we're looking forward to the next time around.
Thank you for having me.
We'll see you guys soon.